Can I survive a market downturn by only investing in index funds? Index funds have taken the investing world by storm, offering a straightforward way to tap into the market's growth without the fuss of picking individual stocks. They're praised for their low fees, diversification, and simplicity. But with market downturns being a natural part of the investing cycle, a pressing question arises: could index funds actually make things worse during a market slump? The concern here is about a potential doom loop. Imagine a scenario where investors, spooked by a declining market, start pulling their money out of index funds. These funds, by their nature, automatically invest in a broad spectrum of stocks. So, if lots of investors sell their index fund shares, the fund managers have to sell the underlying stocks to meet the demand. This could lead to a sharp decline in stock prices, which in turn could spook even more investors into selling, creating a vicious cycle. Index funds work by pooling money from many investors to buy a wide array of stocks, mirroring a specific market index like the S&P 500. When you buy an index fund, you're essentially buying a tiny piece of all the stocks in that index. The funds periodically rebalance to ensure they stay aligned with the index. The worry is that if a lot of investors decide to sell their index fund shares at the same time, fund managers might have to sell stocks quickly, potentially driving prices down. This could theoretically put more downward pressure on the market. Critics argue this could be particularly problematic if a large index fund has to sell a significant portion of a particular stock, potentially flooding the market and causing the price to plummet. However, it's worth noting that this topic is highly debated among financial experts. The idea that index funds could make a market downturn worse sounds concerning, but many experts disagree with this view. They point out that index funds are generally less likely to engage in the kind of rapid-fire selling that could exacerbate a downturn, compared to actively managed funds. Actively managed funds often have to sell stocks quickly to meet investor redemptions or to adjust their portfolios based on the fund manager's decisions. Index funds, on the other hand, typically follow a more systematic approach to selling and buying stocks. Furthermore, studies have shown that index funds tend to be more stable during market downturns, partly because they don't have the same pressure to sell stocks quickly to meet investor withdrawals. The prevailing expert consensus seems to be that while index funds aren't immune to market volatility, they're unlikely to be the main drivers of a market downturn. Their low-cost structure and diversified nature tend to make them a stable choice for investors. Most evidence suggests that the benefits of index funds, such as lower fees and broad diversification, still outweigh the theoretical risks associated with their potential impact on market downturns. So, what's the key takeaway? While the idea of index funds worsening a downturn makes for an interesting thought experiment, the current consensus leans towards their impact being overstated. For most investors, the benefits of index funds likely still outweigh these theoretical risks. We'd love to hear your thoughts. Do you think index funds could pose a risk during a market downturn? Share your views in the comments below. Don't forget to subscribe for more insights into market trends and investing strategies.